Well, hello, everyone, and welcome. My name is Tom Steinley. I'm the Director of Business Development at Lear. We're joined today, as we are each month, by Jim Warner, Head of Research and Co-Portfolio Manager. On behalf of Jim and myself, thank you for spending time with us for our market update and strategy webinar. Remember, this webinar is for you, and as such, we'd like to encourage you to ask questions through the Q&A box down at the bottom of your screen. March is likely the best time of the year if you're a basketball fan. It doesn't get any better than March Madness. NCAA tournament is right around the corner, but March offers a little something for everyone. If you're a fan of politics in an election year, March often offers Super Tuesday, which I'm sure Jim will talk a little bit about. And if you're a fan of stocks, March holds the upcoming Fed meeting and its potential implications on the market. Jim, although it's probably not included in your presentation, as I turn the webinar over to you, perhaps you'd like to speculate on whether your Virginia Cavs will make the tournament this year.
Thanks for putting me on the spot on that one, Tom. God only knows. I don't know which team. It depends on which team shows up. Yeah, so with that, thank you, Tom. And thanks everyone for joining me and us and Tom today. As always, we do a Q&A towards the end of the session, and so feel free. It's anonymous, so we're here to obviously help you understand what's going on in the market and how we're positioning the portfolio. And so the title of this month's presentation is "Housing Prices on the Brink of Collapse?" ? Now, one of the things that longtime listeners know is that the purpose of this presentation is a couple-fold. Number one is, we want to explain what's going on in the market so that you have talking points when you speak to clients and understand what's happening. And number two, we want to look around the corner and look into our crystal ball and see what could move the markets in the future. And then thirdly, we want to talk about what we're actually doing in portfolios and how this all translates. So without further ado, let's jump into this. So, during the course of this year, essentially the equity indices have been very strong. There was a little bit of pullback in January, but February was very strong across the board. Interestingly, the S&P 500 and the NASDAQ are up about 7% each. And so, as you know, we've had this very different types of performance between the S&P and the NASDAQ over the course of the last few years. But so far this year, it's actually the two have been very similar. The equal weight, which we like to look at because it sort of it diffuses the influence of the Magnificent Seven, is up about 3-ish%. So it's even the rest of the market, if you will, has been participating. The only thing that hasn't been participating is our bonds. In fact, the aggregate bond index is down about 2%. Now, the last couple of days, we've seen it kind of trade up a bit, but it's been a laggard. So if you have bonds in your portfolio, it's been a laggard. Now, we don't think that's going to continue. We still remain very optimistic about the prospects for bonds this year, and you'll get a sense for why as we get further through this presentation. I like to start on this. Look at this inflation dashboard, if you will. Core PCE, obviously the Fed's favorite inflation gauge, continues to trend back towards a 2% target. And I introduced last month this concept of the spread, or the difference between the Fed funds effective rate and inflation. So the chart on the right, what you can see is that whenever the Fed funds rate gets too high relative to inflation, we usually have a bubble burst, and then that's followed by some sort of a crisis or a recession. It first happened back in 2000, which of course is the dot-com bubble. It happened back in 2007 when we had the housing crisis and global financial crisis. And now we're starting to see that spread march back towards those levels. And this is a point of concern. This is an indication, in our view, that the Fed may have kept rates too high for too long. And so when we think about the Fed and the commentary, just today, we have Chair Powell in front of the House testifying. The Fed speak as it is today is higher for longer. And there might be a cut, he suggested in his prepared remarks this year. So this is really important to keep in mind as we think about the rest of this year is, will the Fed leave rates too high for too long? Because historically speaking, that creates a huge problem. So during the month, what we saw, and this is what really ailed the fixed income market, was we saw higher interest rates. And some of this may have been due to what was perceived to be a hotter than expected CPI print, which we all know now was basically due to some very weird revisions to some of the housing subcomponents. But not to belabor the point, what effectively happened is we saw the whole Fed funds curve shift upwards. And you can see that in this graph. And it was pretty dramatic. And that was actually why you saw fixed income trade off. And so where we sit today is that the market is expecting the Fed to first cut rates either at the June or July meeting, depending on the day. And that we do think that core PCE print that we got last week is going to be helpful in mitigating inflation fear. So more than likely, we're going to continue to see rates decline from here. Now, I've posted the core PCE graph again here because, you know, one of the things that we do, we obviously talk to a lot of financial advisors who need to talk to their clients and then help them understand what is driving the market. And by the way, it isn't just artificial intelligence, although that's a very important component. But really, it's inflation and it's the labor market. And why the labor market? Because that's what's driving the consumer spending and hence the economy. And right now, we're in kind of a Goldilocks type situation where we've got essentially lowish inflation and still very strong economic growth. And so, you know, the concern that we have, if any, is that if we keep rates too high, we're going to start to see weakness first come out in payrolls. And so we're watching that very closely. Now, we're going to talk a lot about housing inflation related to housing. And so it's important to basically strip out from core PCE the housing component from everything else. We'll just call that non-housing. Housing actually only comprises about 17.5% of core PCE. But as you can see from the dark bars in this graph, it's still running really hot. And it really hasn't come down a whole lot, at least according to the way the government surveys folks on housing prices. And you can see that basically implied even in the most recent core PCE number that the housing component of core PCE was still up 6.1% year over year. And if you stripped out the housing part, the rest of core PCE is running at only 2.2%. So in other words, everything other than housing is essentially back to normal. So let's focus in on housing because that's really the key thing to understanding the direction, not only of inflation, but ultimately of when the Fed is going to need to start cutting rates. So we're going to do a little deep dive. And so join me as we go down this rabbit hole because this is something that is really, really interesting. I'm not aware of many other people that are talking about this. So this is, I think, differentiated research. But one of the things that we know in Econ 101 is that prices are set based on supply and demand. So the first thing that we're going to look at is demand for housing. And obviously, if we have fewer buyers than sellers, prices are going to decline. And given that we're on the cusp of the spring selling season for homes, it's really important that we watch how this market evolves. And the real question, obviously, is will buyers show up? Well, right now we know, and this is just data from the National Association of Realtors, that the combination of very high price appreciation over the last few years and high mortgage rates have priced many buyers out of the market completely. This is record unaffordability. We've not seen this level in the history of this data being collected. Okay, that's how extreme the unaffordability is. And I know many of you probably have a sense for that. The other thing that's happening is that we've had, revaluations of houses. And so people are paying much higher property taxes. And in many parts of the country, insurance rates have gone through the roof. And this has only exacerbated on the unaffordability of homes. So from this vantage point, it doesn't look very good that buyers are going to show up this spring selling season. Another thing that suggests that buyers aren't going to show up is just to look at where price to income ratios, home price to income ratios have gone. And they are very stretched, never been more stretched. The median U.S. house prices, according to the Fed, are up nearly 40% since 2019. But median incomes are much less than that. And so if we just graph that, you can see on the graph on the left that since 1984, which is as far back as this data goes, we have never had this sized home price to income ratio. And then what I did was on the graph on the right is mortgage lenders typically have this rule of 28, and basically the idea is that your income should be at least 28% of the home value. And so if you actually you use sort of the median household income over time and you divide by 0.28, you can sort of back into what the max implied home price should be based on this rule. And then I compared that to the median home value. And it turns out that we are way stretched on that metric as well. The median home values are much higher than what the rule of 28 would suggest, which, by the way, means getting a mortgage, even if you could afford a house, is going to be difficult. Another couple of signs of very bleak buyer interest is home buyer traffic is down near record lows, not quite as low as during the housing crisis, but still near pandemic lows. And mortgage applications are still at rock bottom levels. And this is actually probably the leading indicator. So if you're playing at home, one of the things that you can watch to see how bad things could get from the demand side of things for homes is to look at this metric, right? Basically what happens is that when you want to go buy a home, you go out and first get approved for a mortgage. So this is the leading indicator. And right now it remains at near rock bottom levels. And if we even look to Google search trends and we look to see how the search prompt homes for sale is trending, we can see that here too, it shows substantially lower home buyer interest, down almost 50% from the peak back in the spring of 2021, and even down, double digits year over year. So there's not a lot of traffic out there folks looking for homes. So now let's look at the supply side of things. And as we all know, the supply of homes for sale has been at a record low. And this has led some people to believe that home prices for some reason can continue to remain elevated. But I think that is probably no longer the case. And in fact, what we are starting to see is evidence that there are forced sellers that are going to emerge this spring. The most important indicator to look at is listings growth. So obviously, Econ 101, if there's more sellers than buyers, prices decline. And so while we know there's not a lot of buyers out there, are there going to be more sellers showing up? And one of the things that we're already starting to see this year is growth in new listings year over year. And so this is a super important metric to watch if you're looking to see whether there's a flood of inventory that comes onto the market. And obviously, we're still kind of early. Here in Texas, the spring selling season is just sort of starting. It's going to be obviously a month or two from now for folks up north. But this is what we're going to be watching. This is very important. And we already can see that through the end of February, new listings growth is up 13% versus a year ago. So very important to watch there. If we look at actually where in the country is experiencing the largest listings growth, not surprisingly, these are southern cities, given what I just mentioned about the earlier spring selling season. But Dallas, Jacksonville, Austin, Fort Worth, Miami, these metro areas are seeing massive surges in listings. And now some of this, again, could be based on maybe more favorable weather. We've had some really nice weather here in the last couple of weeks in Dallas. But the reality is, this is something that we need to watch very closely. Austin is already experiencing significant haircuts in price. That started last year. The Miami market is a mess, and we're going to get into that here in a second. I think the epicenter, pardon me, the epicenter of this home pricing collapse is going to be Florida. Here again, we're looking at new listings, but specifically in Sarasota County, Florida. But this is the same chart for virtually every single county, particularly those on the coast, both coasts of Florida. And what you're seeing is that year to date, the listing inventory, the new listings in Sarasota are running 20 to 30% above last year. That's this yellow line right here. One of the things that could be causing this is the massive surge in home insurance that Floridians are paying. Remember, they've had a couple of nasty hurricanes within the last couple of years. But the data that we have uncovered is that home insurance premiums year over year are up over 40%. In most cases, they're up 100% over the last 2 years. So this is causing substantial stress on homeowners. And by the way, not just homeowners, but condo owners as well, because this gets passed through their HOA. And it doesn't take much Googling to see, homeowners associations, people losing literally their minds because they've seen their HOA fees double or sometimes, in some cases, triple. This is going to put a lot of pressure, not just on particularly people who have fixed incomes, but it's going to also put a lot of pressure on all those folks that own Airbnbs. And in some of these communities, 1 out of every 3, in some cases, 1 out of every 2 homes are owned by Airbnbers. And so it's going to be very interesting to watch how these markets evolve, because these ones, I think, we've identified them to be, particularly at risk. So, what happens essentially in a buyer's market when there are no buyers? Because that's that's essentially what we see occurring. And obviously, prices are going to have to decline. You can see this just happens to be new one-family homes, but we think that existing homes are going to catch up to this. But when you get over 6 months of supply inventory in the market, that's a buyer's market. But what happens when there's no buyers? And so that's what we're seeing is across the board in many locations, not just Florida, you're seeing a surge in listings, a surge in inventory at a time when there's no buyers. So one of the things that obviously now the first question that goes through my head is, does this lead to some sort of a housing crisis? And there's a lot of reasons why it may not, because number one, a lot of these homes that need to be sold have very high loan to values. Given the recent price appreciation, many homes, the average home is sitting on 50% loan to value at this point. So there's a lot of cushion, i.e. prices can fall very, very far without causing stress, at least on that metric. But we are watching mortgage delinquencies. And in this case, what we really care about are 30+ day delinquencies, because these are really stressed homeowners. And as you can see from this chart, which goes all the way back to 2005, we are nowhere close to the stress levels experienced, back during the housing crisis. In fact, we're just basically coming up to normal levels of delinquencies post pandemic. So worth watching. This isn't to, alarm anyone, but the reality is that you're going to see prices decline. And if prices decline a material amount, like we've talked about in prior calls, the Fed is going to have to cut. Right? Rates are going lower. And that's a great market for bonds. Now, if things don't get too bad and we just see sort of a gentle sort of pullback, if you will, in home prices, that'll be good for stocks too. But we got to be careful. So as we think about, as we look at the market today, the market backdrop is actually pretty positive right now. So putting this housing thing aside, we've got inflation heading lower, which means lower interest rates. We've got the economy still in really fairly strong, great labor market. Consumer spending remains robust. But we are worried about the gathering clouds that the housing market could pose to the economy. Obviously, various sectors like artificial intelligence are experiencing generational surges in demand. And so, in all cases, right, even when there's some cloudiness on the economic horizon, there are always places to go in the market to find attractive value and attractive secular tailwinds. And as as you know, that's how we invest. We invest a lot in these strong secular tailwinds that even if the economy faces some sort of a pullback, the demand for the products and services of those types of companies tends to remain robust. So short term, though, putting all of this together, and I'd say this is the next 3, maybe 6 months, but is we could continue to see the equity market rally. I would caution about chasing excesses. There are obviously a lot of stocks out there that have really been on quite a tear. And so we think it's worth, and so you don't want to make a portfolio entirely out of those things, of course, because they could have a very substantial pullback. So we're also have laggards in the portfolio that we think could play catch up in this environment. And like I said previously, we think that bonds are in a nice place right here. The yields are, fabulous if you're a saver. And, given what we see on the horizon in terms of lower interest rates, bonds should start performing here, over the coming months. Now, medium term is where we get into this question about what happened to the spring selling season for homes. And, is there, a hard swallow that we have to take in terms of understanding what the impact that any major price decrease could have? Because, as we've pointed out in the past, if we get enough of a pullback in home prices, the core PCE metric could actually drive down below 0, in which case the market's going to get really concerned about deflation. The Fed's going to have to cut even more aggressively, and generally risk assets don't do so well in that environment. So that's medium term, but something that we're keeping an eye on. And that's why I've just spent so much time going through housing prices, because that's really the key, is what happens there. Of course, I have to mention the election. It's a total wild card. Obviously, after Super Tuesday, it appears that we have another, Trump-Biden election coming up. And we've put out research already about how normally the market rallies, particularly if an incumbent's running, and so almost irrespective of Democrat or Republican, the markets tend to do well. So we don't necessarily see the election as a market moving issue broadly, but as we've said in the past, there could be various sectors that could get a bid. For example, energy might come back into fashion if it looks like Trump's going to win, and and some of a lot of the regulations that Biden has imposed on that industry get removed. So there are cases like that that could create an opportunity for certain sectors to rally. So to get right into the positioning of Global Vigilance, this is our flagship product, as you all know. It has a moderate risk tolerance. So this isn't, it's right now running at roughly 55-60% equities. The rest are bonds and commodities. And so this isn't an all-in strategy. This is what generally most clients want. And so that's why we talk about it. But you can see in this chart on the right, as we've shown before, the various different themes that we like. But the goal here really is to remain balanced in light of what I talked about. We could still have an equity rally, but then there are some, reasons why you really want to have bonds to cover you if housing prices really do fall off a cliff. We have also taken steps to diversify the portfolio internationally by adding more Indian exposure. We also are big believers in the Japanese yen, so that's been added to the portfolio. We've reduced some things that have actually worked quite well, and we've also harvested some losses. As we've pointed out, I'm sure to many people on this call, one of the unique things about the way we manage portfolios is that we don't wait till December to harvest losses or wait till the end of the quarter. This is something that is actually a very important part of our investment process, because we don't know a single client who likes to pay taxes. Lastly, we sort of rebalanced some outperformers like Datadog, and we've added some uranium. We're a big believer that uranium is kind of the commodity of the future. There's just no disputing the fact that there's a lot of development going on in terms of using nuclear for electricity generation. in short, one of the big themes that we have in this portfolio is that there's not enough electricity, to power all the things that need to get electrified in the future. We are so far short of being able to supply the power demands in the next 10 years. I mean, think about the hundreds and hundreds of data centers that are getting built. This is even beyond electric vehicles. There's just no way we can power them. And so that's been a big, big thesis in the portfolio. I've added also into this presentation, and then after this, I'll stop, so get your questions ready. This is our tilt portfolio. So global vigilance, as I mentioned, is the moderate kind of risk tolerance, but our global vigilance tilt is our aggressive one. And of course, we have a conservative one as well, but tilt is one that's getting a lot of traction with advisors these days. And so it's incumbent upon me to introduce it. Here, basically, there's really two major differences between tilt and the moderate. One is the equity allocation, of course, is much higher. It's a little north of 80% right now in tilt. But also some of the holdings are different. And so, for example, in this particular one, we explicitly hold NVIDIA, where we implicitly hold it in the moderate through a couple ETFs. Why is that a good example? Well, NVIDIA is a 2 beta stock. It's a much higher beta stock. It creates much more portfolio volatility, and it's much riskier. And so we will add riskier names that we think have tremendous upside, of course, but we'll add riskier names to the tilt portfolio as opposed to the moderate portfolio. So let me stop there and take questions.
So I'd like to just remind everybody that because we're on a webinar, the only way to be able to communicate questions to us is through the Q&A box. So please do that. And while you are thinking about and maybe communicating your questions, Jim, let me tell you, when I'm out talking to advisors, there's a couple of questions that I've gotten recently that may be on the minds of some of the people that are on the call here. One of them is having to do with the recent addition of the gold miners ETF. And just out of curiosity, what was the purpose of adding that? And what are the diversification benefits over just owning the commodity itself?
Yeah, so we own the commodity, as you know, in a number of our different portfolios as a diversification tool. But we're actually becoming more and more bullish on the gold miners. And really the reason is largely relative valuation. Not surprisingly, gold and gold miners tend to track each other, right? And because so much of, gold miners have a very difficult time sort of toggling on and off volume. And so what you generally get is, improved earnings when gold prices are higher, obviously. And so the two tend to track each other. Now, gold miners tend to have a bit more beta to them. So they tend to, when gold prices are moving up, they tend to move up more. But interestingly, over the course of the last few months, the gold miners have actually, as a group, have really not traded up along with gold. And so one of the things that we think is certainly over the near term is there's a pretty obvious arbitrage here where we want to own those gold miners because they will eventually catch up to the commodity price.
Great. Yeah, thanks. That makes sense. There's a question in the Q&A box, pardon me, that reads, Zoom had a pop last week. Are they a buyout candidate, and how do they compete with Microsoft Teams?
Yeah. So Zoom's been in the portfolio, and it honestly has not done much. They did just report, they got a little pop, which is nice. The principal reason why they got the pop, first of all, everybody knows what Zoom is. Obviously, we're on Zoom right now. And we all know that everybody used it during, the pandemic. It was like a lifeline. But yet here we are still using it. And one of the things that they've done to their business is they have developed a whole enterprise side of the business, and they don't just do webinars and video chat anymore. They've got a whole bunch of other products that they've been rolling out. But growth has been pretty soft, and it's been essentially a flattish type grower. And so people are waiting for the growth to come back in, which we think, based on their recent guidance, should start to kick in towards the latter half of this year. So why are we here now? Well, they are the most overcapitalized business that trades in America. They have basically enough cash to retire a third of their stock. And they also have extraordinary amounts of free cash flow. So you combine this very, very cheap stock. It's basically right now a cash flow, but could return to growth, and are going to be buying back shares. That's a great catalyst. So we got in before they basically started buying back shares. On this past quarter, they announced they're going to do $1.5 billion of buybacks. That's a good start. They still have another $6 billion for $5.5 billion of cash on the balance sheet. For a $20 billion company, that's still egregious in my view. And I've spent many hours on the phone with their management team, kind of beating them over the head on this. One of the things that this could do, in fact, is there could be a hostile takeover. They're so cheap, and with all that cash on the balance sheet, it would be, something that I would consider if I was, a Salesforce, or whatnot. But that being said, Zoom's not a seller. Zoom is actually looking to buy things. So I don't think we're going to get a buyout there. And I mean, how does it compare to MS Teams? I mean, I don't know. I think MS Teams is horrible. It's hard to share your screen. It's hard to do a lot of things. Zoom works across all these different platforms. And some people have the misnomer of thinking that Teams is free. Well, it's not free because you have to have all the other Microsoft stuff. And if you're an enterprise, it's definitely not free because you have to monitor it all. So even with an MS Teams out there, you're seeing really, really good retention, and you're starting to see, you're going to start to see that growth. So that's how I would respond to the Zoom question.
Yeah, that's interesting. There is a question here regarding Snowflake. Jim, does the change of the CEO at Snowflake cause us any concern?
In short, yes. I mean, we sort of have had this ever since that announcement. We've had this, we've been really rolling up our sleeves on this one. Snowflake is not a big position, first off. And so it's not super concerning from a portfolio standpoint, but from an individual stock standpoint, we're actually going to have a call with their management team in the next week or two. And they're actually at a bunch of conferences talking about this. Look, at the end of the day, I think generally speaking, markets overreact to CEO changes. This is a guy that's been in there for a number of years. He's a billionaire. And he's just on his way out. That it just is what it is. The where we're focusing our time and attention is on the deviation between bookings growth and revenue growth, which I think we're getting our heads wrapped around. The other thing that we're trying to understand a bit is why they changed their Salesforce compensation. What is really the underlying reason for that? So those are sort of the questions that are still outstanding for us that we're investigating.
Okay, great. Well, let's answer one more question here, and it's going to be a little bit of a combination from one that's in the Q&A chat box and one that I've been asked before. But other than the bonds, given the potential risk of the real estate market, other than the bonds in currently in the portfolio, how is the allocation and global vigilance moderate positioned to be able to withstand the potential risks in the real estate market? And the second part of that, Jim, is what do we foresee for the mortgage bond positions in the portfolio as well?
Yeah, so the vast majority of what we own in the portfolio is our agency mortgage-backed securities. And by virtue of being agency mortgage-backed securities, they are guaranteed by the federal government. So there's no credit risk. And so the amount of actual credit risk that's in the portfolio is pretty de minimis at this point in time. In fact, deliberately so.
Got it. Great. Well, I think that exhausts the questions for now. And that brings us to about 25 minutes to 1 Eastern time. So unless there are any more questions, I think we should wrap it up. And once again, Jim and I would like to thank everybody for attending, and thanks for your support and your trust with your own portfolios and your clients' money as well.
Great.
Hope
Thanks,
everybody has a
everyone.
great week, Jim. Thank you very much.
All right, take care, everyone.